And welcome to this next event by Policy Exchange, focused on the Edinburgh Reforms. This has been a phenomenal year for financial services reform. It is something which has rarely been in the news outside the sort of financial news and the economic news, but under the hood, it has been an area where the government has been making a huge amount of difference and taking forward one of the most ambitious sets of reforms anywhere in the economy and anywhere over the last decade or so. It's a journey that Policy Exchange has been involved with from the very beginning. Last October, we published a report, Unleashing Capital, which looked at how, by reforms to pension funds and insurance, the government could free up over £20 billion on a conservative estimate for greater investment in infrastructure, in venture capital, and in other sources. We had a very wide range of recommendations in that, and we're very pleased that many of these have been subsequently taken forward by government, both initially through announcements and then through law, which became law in July this year. And of course, further reforms were set out in the Chancellor's Mansion House speech earlier this year, and we know that the government continues to be ambitious here. Financial services are a key part of our economy, and they drive not only investment elsewhere in the economy, but they generate the tax base which pays for the public services which the public want and need. Now, today we will be reflecting on those reforms so far, but we will also be looking ahead to the future at where next to go to both bed in those reforms and to continue taking forward that journey to keep British financial services at the very forefront of global competitiveness. We will be looking at how far they are achieving their aims so far, as is recognised to be earlier days, and we will also be looking at the structures on this. For example, one of the major elements of these reforms is that it takes things out of a restrictive retained EU law, which was cumbersome and hard to adjust, and putting them in the scope of the regulator, the FCA, which will be able to implement this more flexibly and we hope appropriately. But of course that relies on having a regulator which is going to regulate flexibly and appropriately, and it will mean a greater responsibility for that regulator as we go forward. I'm very pleased that we have with us today a very distinguished group of panellists, and I will turn first to Andrew Griffith, MP, the City Minister, who is the man who has been driving most of these reforms forward. Andrew, over to you.
Oh, thank you very much, Ian, and so good to see many of you here. It's still relatively early in the morning, so my suspicion is many of you are here because you work in the brilliant financial services sector. You wisely avoided the excesses of the bars late last night, and so let me start by thanking you, because this is a government that is on the side of those that take risk to generate prosperity and reward and the wealth that the country needs. And in so doing delivers an array of life-enhancing financial products. So whether it's access to credit, so people can get their foot on the housing ladder, maybe start a business, take their side hustle and make it their main hustle, the magic, the alchemy of insurance that pulls and transmits risk, so that events in life that could potentially set a family or a business back for generations are miraculously transferred into a simple financial instrument. Or the ability to invest risk capital either at micro or macro scale, delivering good outcomes for the economy. That is what you do. You are doing fantastic work, and it's why we should always thank you and why this government understands and is on your side. And this is the most fantastic industry. It's an honour to be your minister, working with the Chancellor and a Prime Minister who both intrinsically understand the importance of financial services. The UK has a really proud record in this respect. Maybe not perfect analogy, but I say it's sort of like, the automotive industry in Germany. Every politician, every citizen in Germany understands and is proud and feels connected to the automotive industry. And yet the contribution of financial services is around 12% of our entire economy. It's the biggest single sector that we have. And those jobs are not just in the City of London, they're in every constituency up and down the country. So it's a really important sector, and one in which we lead the world in many respects. We do 40% of all FX trades around the world are traded through London here. Our insurance and reinsurance market is the biggest on the planet. People come from the whole world over to lay off risk in the London markets. We have more pension capital than either of Canada and Australia. You hear a lot about their pension funds. We've actually got a bigger pool of capital, the second biggest pool of private pension capital in the world. Our fintech sector has just overtaken that in San Francisco, according to a report from Innovate Finance that was published yesterday. And our stock market is the most international in the world. Others have bigger domestic markets, but if you want that diversity, international exposure, then come to London, because our markets are the most international. And Ian was right. We are here at I hope, a unique moment in time. We've got the ability, and we have used it wisely over the last 12 months to take control of our rule book. Nothing good or bad about that per se, but it does mean that we have one of the factors by which modern economies and states are going to compete, which is agility. We have the ability unilaterally. Friends, we could sit here and now almost and change our rule book. And we're no longer hidebound by the fact that we would have to work in lockstep with 27 other nations. And that gives us, I think, a great advantage to selectively and in a disciplined way, a way that's led by you, the practitioners in the market, not derogate for its own sake, but where there are files that there is particular utility. And a good example, since we're here with the Institute and Faculty of Actuaries, who almost alone amongst me and my colleagues understand the intricacies of Solvency II, or Solvency UK, as it now is, liberating capital to productive uses, delivering better returns for the owners of those capital, that capital, and taking advantage of the fact that in sensible and prudent ways we can change the rule book in a way that delivers better outcomes for society. That's the big higher order objective of our reforms. It's the unifying theme across what could otherwise, look like a quite disparate set of 30 reforms, all under the collective noun of the Edinburgh Reforms. We'll talk about those more later, so I'll stop there, Ian. But you are really at a very exciting moment in time. Our work is not finished. I'd say crudely it's about half done. We've done the heavy lifting on the statute book, and the next year or so is delivering all of the different implementation behind that.
Thank you very much, Andrew. I'll now turn to our next speaker, Matt Saker, the immediate past president of the Institute and Faculty of Actuaries, and who are also very kindly supporting the event today. I know that Matt is intending to look to the future, looking forward at building long-term plans for financial service regulation. I think he may have more chance of reaching bridges across party than he might have done under the previous Labour Party's leader, or he might have been nationalising financial services then. But I think everyone would agree that we want long-term stability and what is best for the country in this. So Matt, over to you.
Thanks. It's great to be here today. And just to introduce myself, Matt Saker. I'm a former president of the Institute and Faculty of Actuaries. I was president until a month ago, but I stepped down very recently. I wanted to start. One of the frustrations in my career, I've been an actuary for 30 years, is that most of the time when I introduce myself as an actuary, most people just don't know what actuaries do. So I'm sure you guys are pretty well informed, but I thought I'd just pause for a minute just to explain what actuaries do and why they're relevant to this debate. So the actuarial profession is relatively small. There's around 100,000 qualified actuaries in the world, compared to probably a couple of million of accountants and lawyers. And our profile is pretty low as well. So if you go into a school and talk to teenagers, they would have heard of accountants, lawyers, but very few will have heard of actuaries and understand what they do. Essentially, actuaries are risk professionals who use a combination of data and expert judgment to make optimal business decisions. You'll find us working in financial services predominantly, largely in life insurance companies and also advising pension schemes. the sort of work that we do, the reason it's quite frustrating that our profile is so low is that the work we do impacts pretty much everyone. So every time you get a renewal letter for your car insurance, it's likely that the premium would have been calculated by an actuary. And we have significant, what I would call public interest roles. So every actuary every insurance company and pension scheme has to have a qualified, certified actuary to sign off certain figures in their balance sheet. So my last proper job before I became president of the Institute of Actuaries was as chief actuary for Aviva, and in that role I had to sign off the two biggest numbers on the balance sheet, the technical provisions, the reserves, and also the capital, and that balance sheet was over half £500 billion. So pretty significant public interest roles that we have, and because of our involvement in that capacity, we're well positioned to lobby and influence long-term reforms, which is what we've been doing, in particular in areas like Solvency II. I'll come back to that in a minute. And I would emphasise the long-term nature of the work we do. So for an actuary, short term is less than 10 years, medium term is 20, and long term is 30, 50 years. One of the roles we do is to project life expectancy and sell policies that are going to be in place for, as I say, 30, 40 years. I just wanted to make a few short points. The first one, building on what I've just said, it's been great to see the long-termism here. So I was pleased to see on the front page here, long-term decisions for a brighter future. Long-term is what actuary is about. I was a little bit perturbed as well because we've been working at the IFOA on our purpose in respect to sustainability, and what we came up with was helping to make better decisions to ensure a sustainable future. So pretty similar. So I don't know whether we use the same PR company as the Conservative Party, but unfortunately we haven't gone public with ours yet, so I suspect we'll have to sort of throw it in the bin and start again, unfortunately. I think the key thing here, though, is these aren't just words. They are converting into actual policies. So all the stuff we've seen recently on Solvency II, Edinburgh Reforms, Green Day, Mention Day Compact, all that is geared towards the long term. I did want to take this opportunity just to plug. One of the things we do is we consider ourselves a learning society. We've just published a new report, Beyond the Next Parliament, which is very much focused on long-termism. It's sort of identifying the shortfalls of looking at things from a short-term perspective and the importance of policy making in the long term. So I'd encourage you to take a look at that. It covers things like the ageing population, the need for social reform, biodiversity, investment in infrastructure, which I'll come back to, and also the impact of the ongoing digital transformation. And actuaries do sit at the heart of this, and we are very, very supportive of the government's vision here. The only thing I think I'd add to that is that we are an independent organisation. We are set up under a Royal Charter, and that charter requires us to act in the public interest. So, our focus largely is to promote growth, but also to challenge and make sure the balance is right, and make sure there isn't too much systemic risk being introduced in the system, and equally that things aren't too benign. Second point I wanted to make was around Solvency II. I realise Solvency II probably isn't top of all of your agendas, but I did want to talk about it briefly and explain why it's important. Solvency II is EU regulation that was introduced in 2016 and controls the capital that insurance companies need to hold across the EU. Like much EU regulation, it was a compromise, and suffice to say, it wasn't optimal for UK insurance companies. UK insurance companies are long-term investors. We write policies for 30, 40 years, and we try and buy assets that match those liabilities. We could invest in government bonds, which would be a very safe thing to do, but they don't offer the returns that we require. So investing in infrastructure and other corporate bonds is really important, in particular infrastructure, and the rules under Solvency II just weren't conducive to that. So what we have here is really a once-in-a-generation opportunity to change that, and to make sure that insurance companies have the incentives they need to invest in infrastructure because they really are, well, insurance companies and pension funds are the natural investors in these long-term projects that take 10 or so years to establish and then produce incomes over their whole lifetime, and those lifetimes can be very long. The other thing to say is in doing that, customers, members of the public also benefit as well. So if insurance companies can invest in the right assets, the right returns, then insurance premiums should reduce as well. So there's a win-win there. Final point I wanted to make was around the Chancellor's recent Mansion House speech. We very much welcome his proposals, his vision to increase pension scheme investment, particularly given that it will undoubtedly, if implemented in the right way, will lead to better long-term outcomes for savers. We've been very supportive of that and other initiatives, such as setting up of collective defined contribution schemes and pension or so-called pension scheme super funds. Again, I'd only add a slight word of caution. It's important that those rules are calibrated appropriately to match the growth requirements with sort of policyholder protection requirements too. And a good example of that is that the Chancellor was advocating for increased investment in unlisted shares, which undoubtedly is a good thing from a growth perspective, and is absolutely the right thing for a customer or a member of the public who is say in their 20s or 30s and looking at a sort of 30-year investment time horizon. Those unlisted shares will fluctuate in that period, but over that long period, they're likely to increase significantly and grow significantly. Less appropriate that someone in their 60s who's 1 or 2 years away from retirement invests in those funds, because they could quite easily see a 20% drop in the value of their assets just before they retire, which clearly would not be a great outcome for them. That's a bit of an extreme example, but you take my point that it's the devil with all these things is in the detail. I'll leave it there, but I look forward to the rest of the discussion.
Yeah. Thank you very much indeed, Matt. And we'll last turn to Juliet Samuel, a columnist at The Times. If you're familiar with her work, Juliet writes extensively on the British economy, on industrial strategy, on financial reforms, and more broadly. And Juliet, I'd love to hear your take on what these financial reforms mean for the British economy more widely, and indeed what more we need to do.
Well, I think it's undoubtedly a good thing that we've finally seen post-Brexit the government take ownership of this whole area, because it was pretty obvious from quite early on during Brexit negotiations that the city was going to be going its own way, and yet it took many years for the government to admit that and to start actually looking at how it could overhaul the huge amount of EU regulation governing this industry and how it could improve it. And I think there's definitely some positive stuff happening, not least Solvency II, pension consolidation, the attempt to get more risk capital into productive investment, and to look at why that's not happening as much as it should. And then the growth of new industries, whether it's fintech or crypto, done carefully. The UK seems to be one of the few jurisdictions that's prepared to, in the wake of some of the blow-ups, have a look at that. So I think, I think it's also a good thing for the regulators to have to think about competitiveness, which they certainly did not have to do after 2008. And which actually now in the financial industry alone, among regulators, now have to consider the competitiveness of the industry they regulate. And it's something you could ask why that would not be extended to other industries as well, not least industrial production. So I think there's positive stuff going on. That said, I think the overall picture is rather a bit bleaker than that. You've got the London Stock Exchange shrinking effectively. You talk to businesses who are thinking of listing. I spoke to just one tech business that they have a small US business, but they're a British-based company. And they're not ready to list yet. They're thinking of listing further down the line. And they went to see LSE, and they went to see the New York Stock Exchange, and they said the New York Stock Exchange sat them down and talked about what their business needs and what their growth plan is, and keep in touch with us. A few years down the line, you'll be ready to list, and we'll talk to you. And the LSE just wanted to talk. How much can we list now, immediately, as soon as possible, to get some activity on the market? So it's a slight death spiral dynamic there, and I think there hasn't really been enough examination of why that's happened. I mean, maybe it's interest rates are going up, so you're going to see less activity. On the other hand, London is particularly affected. There has to be a Brexit question as to what the impact of that is, but also, I don't think anyone has fully sorted through all of the post-2008 reforms and what the knock-on effect of many of those has been. You've also had the LDI blow up in the gilt market last year, which, while precipitated by reckless government, is not something that our financial regulators should have been completely unaware of. And you've had certainly a eroding confidence in the ability of the Bank of England to do its job, not just among, seasoned market participants, but also alumni of the bank itself. You've had strong criticism from the likes of Mervyn King, criticising it for diluting its priorities, being diluted with climate and other activity when it needs to, look to interest rates. The membership of the MPC is, recent appointments don't seem to be of the calibre that we had in the past. And I think that's pretty damaging for the reputation of the UK, as well as for the management of the UK economy. And then you have the FCA, which is, as Andrew said, taking on a lot more responsibility, which it should, which it needs to do. But there is a question as to whether it's up to that. I mean, most of the extraneous gold plating of EU regulation that happened was at the behest of the FCA. And you still have odd hangovers from that, like, the need to pay for investment bank research, which was never really justified and is still kind of hanging around there, messing up the flow of information. And, you seem to have a lot of displacement activity on sort of D&I initiatives instead of on, what we want markets to do, which is to function efficiently and with integrity. So I think there's some good stuff happening, but I think the overall picture, hasn't really been looked through with a view to what we want the city to do. And I think the last point on this is that the government hasn't yet really decided to harness what is a huge asset of the UK, the financial sector, to enable the rest of the economy to come up, to level up and to compete globally. And what we really need is to link up our amazing financial services industry with industry, with academia, with science. We need to scale up the British Business Bank, the Patient Capital Fund, and we need to put all of this expertise at the disposal of huge growth areas that we could be investing more in the UK. And that, I think, is something the government is not yet got its head around.
Thank you very much, Juliet. I'll just ask a couple of questions as chair and then turn to the floor for more questions. Andrew, I'd like to turn to you first, so pick up Juliet's last point about harnessing the financial services to the rest of the economy. So we had your ministerial colleague here yesterday, Claire Coutinho, talking about the trillions of pounds that were needed for energy infrastructure to achieve net zero by 2050. How are you and your colleagues working to get that harnessing of our financial assets into the rest of the economy?
Well, I stumble over the word harnessing because I don't think it's the work of government to harness. We spend enough of our time, generally working, for government. So our job, the job that I've got for the Prime Minister and the Chancellor, is actually to remove friction, to remove the impedances and allow capital, the fantastic problem-solving power of private capital, then to do its job. Supply meeting demand, supply of opportunities to meet the demand for people to invest for the long term, to make a proper return. And I have to say, I don't quite recognise, you might expect me to say this, but I don't quite recognise the gloomy situation that Juliet talks about. Day after day, just down the road in Leeds, the UK Infrastructure Bank does two things. One, it puts government risk capital to work. At every single point of the funding curve, it does long-term index-linked guarantees, it will take equity, it will take debt in big infrastructure, both in pursuit of levelling up and net zero. Innovation happening right now, it's open for business, and it both allocates capital, but it also acts as a clearinghouse for opportunities. One of the challenges is people start to look at how to deploy some of this pension fund capital where we're recalibrating the risk appetite. The estimated £100 billion, right? There's a big number, Juliet. £100 billion that is being freed up from institutional capital as a result of Solvency II. And I know from sitting down weekly, if not monthly, with the people like Aviva, Phoenix, the Pension Investment Corporation, they're devoting executive mind time right now as to how they can start to deploy that capital. One of the barriers is simply finding those opportunities. They're out there, but just how does that effective market work? And the UK Infrastructure Bank is doing a good job of also being a clearinghouse for those things. So it's clearly more to do. I don't disagree with anyone on the fact that we are midway through this ambitious process of reform. We're at the point where the sausages are starting to come out of the machine, but the machine's been whirring for a little while, and now we're going to see a lot more sausages come out in the coming weeks.
Brilliant, thank you. Matt, I'd like to pick up a little bit more on the regulators here. As Juliet says, the gold plating has not always been imposed on us externally. We did some work at Policy Exchange on anti-money laundering regulation. Obviously very important that we protect anti-money laundering, but we found a very strong and consistent evidence that the activity being required was not necessarily helping to achieve that aim, was adding considerable burden. And then just last week, for example, we suddenly had dropped some new diversity regulations, which would, by their own analysis, add £300 million of cost every year to the British financial services. Not to say commenting on it, but do you think the regulators are listening to industry enough? Where would you like ministers or the government to potentially do more with regulators so that they can be that flexible, nimble, agile regulatory system that we have?
Yes, it's a good question. I mean, I think my experience, and I spent a lot of time at Aviva dealing with regulators, is that they are pretty reasonable people, and they do tend to listen. And there's some good examples of that quite recently. I think the consumer duty reforms that have been brought in recently. Actually, I think everyone gave out a big sigh when they saw that was coming in. But my experience actually sitting on a couple of boards of insurance companies now is that actually they are a good thing. They are genuinely leading to better customer outcomes. So I think things are working well. Juliet mentioned the LDI crisis, if I should call it that. That's I guess it's almost a year ago since that happened, and I think that's another example actually where regulators and ministers have worked well together. Fundamentally, LDI investment has been a good thing for pension funds. If you look over the last decade, they just weren't prepared for the extreme movement in interest rates that we saw over a very short period. And that it didn't cause a capital issue, it caused a liquidity issue, as is quite often the case in these instances. So the government did step in. But I think there's been a good process that's run since then, involving ministers and regulators to understand the issues and to not throw the baby out with the bathwater. It would have been very tempting just to introduce regulation that banned LDIs. That wouldn't have been the right outcome. The right outcome is to recognise the risk and make sure the controls and processes are put in place to make sure that sort of thing doesn't happen again. So I think that's a very good example where it is working well. At the IFOA, one of our roles is to lobby and to engage with regulators and ministers, and we try and do that, and we'll continue to do that.
Thank you. And Juliet, slightly more wildcard question for you, but on the subject of levelling up. The City of London has, historically been the heart of Britain's financial services. It has been across every constituency of the country, as Andrew said, but it has traditionally been concentrated. What do you think remote working has for the potential on levelling up, or to allow the financial services sector and some of these very high-paying jobs to be spread throughout the country?
Not a huge amount. I think that it's introduced some flexibility, which is good, but I think fundamentally, especially in some of the more intense jobs, you need the ecosystem effect of people coming into the office, especially for younger people starting their careers. It's a huge disadvantage if that's not going to happen. It's a huge disadvantage to them. I think maybe it's been helpful in terms of eliminating some of the time-wasting travel for board meetings, that kind of thing, and making some of that more efficient. But I think there are losses as well as gains, and so I don't think fundamentally that will decentralize, this industry. At the margins, it might change things.
Amanda, you wanted to come in there?
Can I just come in on the really important point about culture? If I think about the three things that we have to do to simplify, we have to improve our rule book to get it to be internationally competitive. And that work is in hand, and I've got clear line of sight to do that. That's been the job of work for the last year, and we've got more work to do. The second job we have to do is mobilise more capital in pursuit of risk. Just slightly resetting the balance. I don't want people to mischaracterise it about the extremity, but since 2008, the broad thrust has been to try and extinguish risk. And if you do that, you have deleterious societal consequences, not least of which people will have poorer pensions in retirement than they otherwise would. So whether that's institutional capital, pension capital, or as I am doing some work on right now, private capital, savings and investments, we want to try and mobilise more of that capital to productive uses in a sensible framework supported by the brilliant actuarial profession. We need more than 100,000 actuaries. The world will be a better place. But the third piece is culture, and that's culture at every level. So it is a culture at the regulators, and it's a culture of focusing on what matters. I would say improving the clock speed of the basics. There's things like the pace of authorizations. Most people who work in the financial sector require some sort of authorization. It's a fairly basic, piece of workflow. It can be digitalized, and we want to try and see that compress. I think that they would share that aspiration, but there's a question about the pace with which they achieve that, because it's a really important competitive metric, when people are looking at global locations as to where to be. There's also a point about where our regulators do spend their discretionary time. I would argue at this particular moment in time, focusing on growth and international competitiveness, a new duty laid down not by myself or the Chancellor, but laid down by Parliament, is something that we really want to hear more from the regulators as to how they achieve that. And we put in place some accountability mechanisms in order that we can hear a lot more about that. So I hope if you meet a regulator, one of the questions on your meeting list is, could you tell us what you're doing to help us on growth and international competitiveness? It's not the only objective. No one should have solitary objectives. They've still got their prudential objectives and others, but it is a new one to add into the mix. And I hope we'd all hear more from them over the coming weeks and months about how they're going to deliver that objective. And then thirdly, the thing we're doing here as a society is also having a debate about risk and wealth creation and what we can do to support and foster those who are taking risk, whether it's in business or it's investing private capital to deliver the returns that society needs. Some societies perhaps a little bit better than that. One of the reasons why parts of the world like California are so prodigious. Yes, there's some particular factors of production. There's a particular business mix that has prospered over the last couple of decades. But I think it would not be right to sort of not see what we could learn in terms of attitudes to risk and failure from markets like that. That's something we can't do alone. The Prime Minister, the Chancellor, myself, we can't do that. That's a societal conversation. But therein lies a huge opportunity, given the amount of capital that we have as a society to deploy if we get it right.
No, thank you very much, Minister.
Sorry, can I just add? I mean,
One quickly, and then I want to make sure we have time for questions from
well,
the floor.
we've sort of, Minister just touched on it briefly, but you know, the end game here is to get better customer outcomes. You know, we are very concerned that there's a massive gap. 60% of people are expected in the next generation to retire with an inadequate income. And that is a massive issue that we need to address. And all these initiatives around growth should be looking at that end game to make sure that the members of the public have enough money to live off when they retire. And there is a lot in that, education, using digital tech and everything, but that we shouldn't lose sight of that. The regulation ultimately should be geared towards better outcomes for the public.
Excellent, thank you. Questions from the floor? I'll take 3 at once. Gentleman just here. If I could ask you to just state your name, affiliation, and if you could keep your questions short and to the point.
My name is Howard Hughes. I'm from Barndall Strategy. My question is about gold plating and what can be done to sort it out, because we have a situation in the UK with a growing SME lending from the challenger banking sector, and yet the FCA has embarked on an interpretation of Basel that's so extreme that it could take £44 billion out of that sector because of their gold plating. Who are they trying to please with these measures, and how can the FCA made to focus more on the real economy and actually helping financial services do what it should do?
Brilliant. Thank you very much. Gentleman just here.
Hi, Rashad Ahmed from EMSO Asset Management. What areas would you expect to benefit, or what areas would you expect capital to flow into by having all of this deregulation? I guess, how do you ensure that it benefits Britain and UK society versus just going into the NASDAQ, for example?
Thank you. And the gentleman just at the back there.
Hi, Will Gray from Luther Pendragon. Minister, you spoke earlier about the competitiveness duty and the metrics associated with it. Could you update us on the next steps for the following that consultation, and how soon you expect to bring them forward? And secondly to that, the PRA had their competitiveness conference a couple of weeks ago. It would seem that they are perhaps more lukewarm than you are and the industry are on how forthcoming they'll be in meeting and welcoming the new metrics and that focus on competitiveness. Thanks.
Brilliant. Thank you. I'll ask each of the panel to answer as well, at least one, but as one or more of the questions as they wish. Over to you first.
Okay, I'll try and be brief so we can get more questions in. One of the things, I mean, the Basel 3.1 is still in its discussion phase. That is really important. It's another one of those wonderful things, right? Who'd ever thought Solvency II would be retail politics? But too many of us have been talking about it. Basel 3.1 is one that is well understood. These rules, these standards really, really matter. A lot of our capital flows. So that is understood. We've just effectively deregulated ring fencing. So we've loosened the ring fencing regime again, which will have the side benefit of enhancing SME lending. And it's very important that we have, and there'll always be a bias, I think, for ministers who are vested in growing the whole economy, to have a little bit more of a bias to what are the societal benefits of having a really good environment for SME lending, or to promote growth and competitiveness. The regulators, perhaps it's not unnatural that there'll be one stage removed from that, which is why it's important we have these debates, we have these consultations, and I know it's tedious, but it's also really, really important that as many people as possible respond to consultations. We aspire as a society to practitioner-led regulation, but that requires the practitioner voice to show up. Sometimes we can achieve that by making sure practitioners are well represented in those bodies. They're not consisting entirely of regulators talking to themselves, but the other way is that participants in the industry respond. There, that wasn't at all short, was it? Where will all this wonderful capital flow into? It is the nature of UK financial services and professional services that we are naturally global. We are open by design. It's a feature, not a bug. Virtually every practitioner participates in international markets. And so one would be very loath to start directing capital. There are some jurisdictions that have a predilection for sort of telling, their national champions where they should be putting capital. But I don't think that does ultimately in the long term make their economies more competitive, and actually it pushes up their own cost of capital. So there is a balance here that the first thing that will deliver better outcomes for beneficiaries is people investing in more diverse, slightly more risky asset classes that will generate better rewards. My hope is if we have the combination of supply-side reform, a great economy which has got the infrastructure to support it, and we remove some of the disincentives and potentially shine more of a light through transparency and openness on where investments are actually being deployed, because very few beneficiaries will have clear line of sight to that. We've disintermediated that too much, in my view. Then we will see more of that capital come back into the UK. It's not as high now as it is in some other jurisdictions, but I think we can play some strokes that will help that. And then finally, on the competitiveness metrics, not everybody will be familiar with this, but one of the powers in the new Financial Services Act is for the Treasury, for ministers to impose a set of reported KPI metrics, and we in business know that what gets measured gets managed. And so that is a very important piece of work. You should expect to hear more in the coming weeks and months as we actually go forward and say what those metrics are. There was a very, very good response to the consultation, so thank you. That's going to make my job easier now as we go through and try and sort out what looks like a sensible scorecard that's simply aligned with what matters to you guys.
Thank you very much. Matt?
Yeah, just to add on the capital flow question, so to me it's relatively clear actually. So at the moment the Solvency II rules really don't provide a great incentive for insurance companies certainly to invest in infrastructure, and in particularly green infrastructure. They have to hold too much capital, and that makes it less attractive to them. If we get those changes to the Solvency II rules in Solvency UK right, that should provide the right incentive. And the Minister mentioned a figure of 100 billion. That's what we estimate it will free up in terms of capital available to be invested in, potentially in green infrastructure projects. And that will go a long way. Won't close the gap completely, but it'll go a long way to reaching our net zero aspirations. Just very quickly on the gold plating point, I said regulators are reasonable people. They are, but they're also quite risk averse. And we're actually seeing that at the moment within our profession. We're regulated, and there are proposals to change the way that regulation works through the introduction of ARGA. We're talking to people like the Minister and others to lobby and make sure that it's proportionate. And I think that's the key word here, is that regulation is essential, but it needs to be proportionate, otherwise it will just stifle.
Thank you. And Juliet?
On the competitiveness point, I mean, I have some sympathy with the regulators in that, in some ways, you can argue, well, it's not their job to make sure that Britain, has lots of investment banks or whatever it is. On the other hand, this is a reaction to their complete sort of overreach, trying to nail everything to the floor. And I mean, what you should have is, probably more government control of regulators and, mandates given to them that make clear that you can't simply, if you simply drive risks offshore, that's not considered, good risk management. And I think that applies actually in lots of other areas, or should apply, whether it's the regulation of water or energy emissions, for example. But, so I think there should be more political accountability. I think ultimately the government is responsible for whether this economy is competitive, but I think, the FCA probably only has itself to blame for the fact that there has to be some tempering of their instinct to just shut a lot of stuff down that shouldn't be shut down.
Thank you. We've got time for one more round of questions. The lady in the front just here.
Hi, just to follow up on that competitiveness question from the gentleman behind me. Are there any specific areas, Minister, where you think regulators should be looking at in order to improve Britain's competitiveness on the global stage?
Thank you. Gentleman in the front there.
Thank you very much. Ricardo Tordera from the Payments Association. Minister, you mentioned accountability for regulators. I think this is a very good point. We can see that authorizations are still very slow. The consumer duty will impact the industry in a massive way, and the PSI is trying to introduce a mandatory reimbursement that will be a burden on the industry, and it doesn't resolve the problem of fraud. It's just put a plaster, but we will have to pay for this. So having regulators accountable will impact the industry and will make us better. But I didn't really understand when these things are coming. I would like you to expand on this, please.
Thank you. And the gentleman standing in the middle at the back.
Hi there, Deji here, banker at Standard Chartered. So I had a question on how to encourage, I guess, startup investments by pension funds in the UK. As you know, I mean, I guess recent IPOs, ARM, for example, they've been listing more and more tech companies have been listing in the US because of, I guess, UK is as buoyant in terms of valuation and that kind of thing. So in terms of, I guess, I mean, pensions generally have one of the largest pool of funds in the UK. So how do we get more pensions to be investing in more riskier assets, like, for example, IPOs, or, for example, investing in startups and things like that as well? So what's your view on that, and how can regulation and government policy help improve that?
Thank you. We'll go in reverse order this time. So, Juliet.
Well, I think, honestly, I think these are, I think the Solvency II stuff will help. I think pensions, there's been a lot of talk about consolidating pension funds into super funds for a really, really long time, certainly since I started covering financial services, which was more than 10 years ago. So it would be nice to know if and how that's going to happen, because if you had some pooling of expertise, then maybe you could develop more of along the lines of the Canadian or Australian funds who are much more serious about taking big risks and funding large infrastructure. So on the infrastructure point, or getting pension money into these projects, I think part of that is the government needs to provide a better environment for building infrastructure and for the idea that infrastructure will be built. I don't think the high-speed 2 stuff this week is particularly helpful on that front.
Thank you. And Matt?
Yeah, on the pension fund point, so I mean, it's a complex market. You've got defined benefit final salary schemes, you've also got defined contribution schemes. On the former, there's far too many tiny defined benefit pension schemes still that don't have the expertise or the scale to invest in the sort of projects you've talked about, which is why, as Juliet says, consolidating those funds into bigger super funds where they will have the clout to sort of buy the complex instruments that are needed and have the ability to take the risk that's needed, because what you're talking about is typically at the higher end of the risk spectrum. Small funds can't take that, and similarly on DC, so defined contribution side, one of the things we've been promoting as a profession is the setting up of consolidated defined contribution schemes, which again will allow individuals can't manage that risk themselves. It has to be done by an entity that has the expertise to invest in those sort of complex instruments. Individuals don't have the knowledge or skills to do that. So both of those initiatives, I think, are important.
Thank you. And we'll let the Minister have the final say.
Look, a few things to wrap up. First of all, competitiveness. We've talked about that a lot. That is here and now and live. That is a live duty that Parliament has imposed. We're in the process of instrumenting some of that, but there's a number of different ways that will bite in terms of the agenda for the regulators' work, where they focus, but also the speed with which they operate. And as I said before, that's a conversation you can have with them across all of their domains. When we make changes to the point on mandatory reimbursement and payments, we seek to do so in a proportionate way. That's my most favourite word of financial regulation, because the domain is fraught with unintended consequences. You sort of squeeze one end of the balloon by trying to do something that avoids one particular behaviour, and it comes out somewhere else. So it's really, really important that as we act, and sometimes it means that it's better to be right than first, we do so in a proportionate way. And I spend a lot of time looking at that, and a lot of time looking at impact assessments, which are one of the disciplining things on regulation. There's others. There's a new hardwired cost-benefit analysis in the regulators' processes, and a new regulatory complaints commission, who again can hold them to account on that. And I hope, because I think the tone sounds quite glass half empty. Actually, this is a really exciting moment in time, and I think the glass is not only half full; it's more than half full. We are already baked on Solvency II. We've laid the statutory instrument on the risk margin, and we published last week the detail, I think 100 pages of detail on the matching adjustment, which was many happy weekends of box work. On pension funds, the aggregation, and it tends to be that really big change doesn't happen with one single measure. It happens through the aggregation of marginal gains, which you accumulate up. All of the different reforms that we're making to pension schemes, including the value for money framework, will promote consolidation, and will see us have really much better pools in which to invest going forward. And then I think the final question was, what areas in particular on the competitiveness agenda? That's a little bit like choosing your favourite child or puppy. But I do think that given the, I think it's often sometimes undue focus of people like Juliet put on the primary listings, there's actually a relatively small part, and the story of those that have gone to the US and actually often been orphaned because it isn't their natural home market if we get the UK markets to work well. But I do think some of the work around the market effectiveness review that will allow a broader range of companies to list at different life stages, even potentially something called an intermittent trading venue, which will provide liquidity for those companies that aren't even fully public, but still have a foot in both camps. Those are all exciting, innovative ideas that mean if we had this conversation again in a year's time, I think we might be talking through a very different lens. Thank you.
Fantastic. Thank you very much. This has been a great event. I think there are two things I would particularly take away, which I find personally very encouraging, is that firstly, after what seemed like almost a decade of recovering from the 2008 crisis, we're not afraid to talk up financial services in this country anymore. It feels exciting. We're willing to do things to keep us at the front of the competitors and to recognise the contribution that they have always made. And the second one is that when people talk about Brexit benefits, I think sometimes people want something you can wave on the front of the, of a tabloid newspaper, and sometimes they are there. But I think far more often, this is what it will look like. It will look like painstaking work around regulations, small changes which together actually add up to keep Britain growing as in the way that we all want and need it to. So I'd like to say a big thank you to our highly expert panel, and thank you to you in the audience.